This is the morning drive. So over the weekend, lots of concern, of course, over the Strait of Hormuz, and it's raising alarms across global energy markets as the crisis is ongoing. Experts think it could ripple through oil, gas, even flight prices, of course, just as demand picks up heading into the summer. So let's look at this as a topic this morning. Mirco Neri is the co-founder and the CEO of Anvik Capital, here to help us unpack what it could mean for markets and consumers in the month ahead. Mirco, good to meet you.
Good morning. Thanks for having me on the show.
You're very welcome. It's good to have you here. Lots to talk about, of course, so I'm going to kind of throw lots of different questions at you, so bear with me. But let's start with, let's look at a trading perspective, your day-to-day kind of work. How significant is the risk around flows in the Strait of Hormuz, actual flows versus market sentiment?
So it's central at the moment, and I would say it always starts from the sentiment, because that is what is driving prices in the financial market. But then it quickly transitioned into actual supply losses, and the fundamentals had to reflect those losses. We started with losses of crude oil and the refined products. And I would say on the refined product side especially, it's where it's showing the most. We've seen this in the distillate space, like jet fuel and diesel, very much hit. And also in the natural gas space, LNG was a big part. It got hit big by this crisis, and we're seeing it spill over into other energy prices, such as electricity and power.
Okay, so the Strait of Hormuz handles, what, 20% of the world's daily oil consumption. We're really seeing legitimately a supply shortage. This is not the market pricing fear in, is it?
Exactly. It started from pricing probably just was out of fear, and what analysts like to call geopolitical risk premium. Sure. But then when you have fundamentals changing and reflecting into supply losses, then prices have to spike even more. It's just I would say our fundamentals and the market mechanism need to reflect. There are even some products, you said 20%, but if we dig into that and we say where the risks are the biggest, jet fuel handles about 45% of global flows pass from Hormuz. Naphtha, which is central for petrochemicals, it's about 40%, and this is, as we have seen, spikes in petrochemical prices in Asia. So when we go into markets that are more, I would say, just in time, they don't have large reserves such as crude oil, the shock is immediate. In days, we have seen those big spikes and multi-year high in the future markets.
Okay. I mean, commodity traders, we all hate uncertainty, but commodity traders in particular don't like uncertainty, probably more than they hate high prices. How much of the recent kind of crude rally is a risk premium that could evaporate as soon as we see, hopefully, see diplomatic de-escalation?
So for crude oil, we think that is going to be the most exposed to a big correction as soon as we're going to see the de-escalation, because globally the world has been prepared for large supply shocks since back into the 70s. Yes, sure. Exactly. Sure. So you remember, it all started with this part of the war. And it's easier to build large oil reserves when it's crude oil. It's easier to store and easy to build cushion. And also we were going into a part of economic and start of the year where stocks were plentiful. And I would say in general, especially with the US becoming such a big producer of crude oil, the crude oil side of the equation is not really the issue. But when we're going to look into refined fuel and the energy like as we need, which, it's not like crude oil. We need refined fuel, we need electricity, we need gas to make the world and the economic machine work. Then it's going to get a little bit more complicated because you have downstream mechanics and refinery economics that have been disrupted by those shortages. sometimes directly or sometimes indirectly by rerouting, long routes, higher cost of freights, higher cost of insurance.
It's not just flicking a switch, is it, to get this back moving?
Yeah.
In refined products like jet fuel or diesel, how quickly can the disruptions, the likes of which we have seen, how quickly does that translate into price spikes?
So that happens within hours or days.
Really?
We have seen on the first day of the war, jet fuel prices decoupling completely from crude oil. They were trading almost at $250 a barrel. If you put things in perspective, it's been the largest move ever on record. Why? Because investors immediately understood that a supply shock that never happened before was in the making, and everyone is talking about diesel and jet fuel because they were particularly tight before the war, this distillate space. And it's a market that we call it's a just-in-time market. Yes. As opposite of crude oil, as we said before, plenty of strategic reserves across the developed and across the world. For distillates, they are products that are produced, very rarely stored, and then immediately consumed, shipped and consumed. It's much more expensive to store, it's much more difficult, and like the machine, the economic machine, especially the European one, is built to rely on imports.
Yes. Yeah, okay. So much tighter conditions for jet fuel and for diesel.
Yes, so jet fuel overall, and then we put at the second place naphtha, and on the third place liquefied natural gas.
Okay. How are regional imbalances, particularly between Europe and the Middle East, shaping the pricing in these products?
So this is really a central one, if not one of the most important. And again, it's quite structural because it's how the European Union and the European policies decided to play the energy transition. They decided to move away from refining as an industry. So you had, over the last 10 to 15 years, a lot of refineries in Europe shutting down. It was not economical, or it was also seen as risky politically. The Middle East jumped on the opportunity. You had countries like the UAE, Saudi, Kuwait, especially building mega refineries, and their natural outlet for their fuels was actually Europe. Here they build it bigger, more advanced, better technology. So it was a no-brainer for them to have as a natural outlet the Europeans that were not as advanced or not as convinced in terms of refining. Now, unfortunately, some of those refineries, and we're talking about 2 million barrels a day of refining, has been taken down from the closure, is either because of attacks or sometimes just because they could not ship out those flows. You also have about 10 million barrels a day of crude oil that has been taken down. Those crude, they were going mainly to Asia, where it would have been refined into the same products. So for the European especially, but even globally, it's difficult even to reroute, because where are they going to go? They can take some from the US and some from West Africa. But the US itself, while the biggest producer of crude, they still rely, for example, in terms of jet fuel from Asia. All the west coast of the US is coming from Asia. So it's tight also even there. We're a little bit in a situation where there is nowhere to hide. And we have an idea of when we're going to see big disruptions, even for consumers. We think that we are just 3 to 4 weeks away from that.
I wanted to ask you some more kind of consumer-based questions, and we'll come to that in a short while. But there's also the balance, isn't there? Because do you think markets are more driven by freight and logistic constraints rather than outright shortages in supply? So
let's look at what the market did. Initially, yes, the freight, especially from the Middle East, which typically are either into Europe or into Asia, they saw the biggest spike, even more than energy prices, because that was the main concern at the beginning. Now, freights are still at really elevated multi-year high, but they somehow came down. And the spillover effect translated into outright fuel prices higher. Because it's not just freight, as it was looking initially. It's actual barrels that are missing from the market.
Right.
And then we can look at the demand side of the equation. Is demand coming down? Not really. Because in developed countries in Asia, across the world, we are looking at flights, for example. We're going into the summer demand season. It's a peak season. It's quite inelastic. Economic analysts would say. It means in normal world, it means that it just people are gonna pay higher prices, but they're gonna still buy tickets for their flights. They're not gonna give up on that.
Well, we hope.
Yeah.
I was going to ask you that. I mean, we're heading into peak travel season, you could argue, particularly in Europe. So how do you see jet fuel demand interacting with those? I mean, the supply chains are tight, aren't they?
So the first step that airlines will have to do is to pass this shock on to the consumer. And they tried already, and they are doing successfully in raising ticket prices.
Right.
So yes, it's. I hope not to be the one bringing the bad news, but I expect much higher ticket prices for the summer. It's unfortunate, but it's the way one of the effects that reflects those tensions. But then the second issue is that the market is trying to price higher because it's trying to to go into demand destruction, or at least disincentivize people from traveling. This, it does not look it's happening. Especially European and US travel demand data are showing that it's very resilient and still growing. So if that doesn't happen, the only last resort mechanism is forced demand destruction. And that is gonna be seen for us as a flight cancellation. We think we are not that far away. Our modeling is telling us that between 3 to 4 weeks in Europe, less profitable routes, peripheral routes, might start to be affected.
Okay, you are bringing the news this morning.
Unfortunately,
I mean, I think we all kind of realise,
yes,
don't we? That's simply the case. What else are you looking for, Mirco, in terms of, I don't know, signals or price levels, so that you can gauge what might be the next move?
So when you start the day, crude oil prices, we mentioned, they are really the biggest indicator and the biggest driver of sentiment, especially across the energy markets. Brent and WTI, for example, very big market, very liquid. Yeah. But those, as we said, they're just the first layer because they don't necessarily reflect what is really happening into the consumer market. No consumer will use crude oil for their energy needs. So then there is a second layer. We go into natural gas prices, but also refined fuel prices. And refined fuel and as well as natural gas, everything we look, how can I say, as a relative value, we like to say. So it means, how do they move comparatively to crude oil? We call those spreads. And those spreads and those premiums are really central because they will determine, for example, whether a refiner has more incentive to produce gasoline versus diesel or versus jet fuel. Now it's very much in favor of diesel and jet fuel. And then another big part of the market, this is a bit more technical, is called in the derivatives market, is options. They measure the volatility. So they tell us, how much are you willing as an investor to pay in order to get protection for extreme price move? And now we are also on those at multi-year size. So it's telling us that the fear component, it's really high and people are willing to pay a lot for those type of insurance.
From your desk, your trading desk here in Dubai, how important has the region become in terms of price discovery and global energy flows. Could you put that into context?
Yes. So, first of all, as we were discussing before, I've been here since 9 years and I've seen it changing.
Yeah.
Because I would say it started as a production hub, the Middle East in general.
Right.
It was where things were produced, but not necessarily processed and not necessarily consumed. Now, it's a big consumer. It's a big refinery, but it's also a big pricing hub. More and more traders moved to the Middle East, and I would say Dubai and Abu Dhabi in particular are central not only of the state-owned, which was the traditional, but also of independent like us traders. We are representing the so-called derivatives trading or paper traders. It means financial traders. We are involved not in moving physical barrel across the world, but in trading thousands of barrels of contracts in the financial markets. And this is what is determining what consumers are going to pay and what producers are going to achieve, because all the physical market is priced out of those important contracts.
So, I mean, more and more, we're kind of a haven for traders, I suppose, aren't we? And that's what's happened. You advise clients on navigating macro shifts, don't you? So, for an investor, if your portfolio is heavily exposed to transport, manufacturing, is it time to maybe hedge with energy futures, or is it too volatile a market?
The issue that we would say now, it would be probably too late, because the move has been already there.
Yeah.
So what we advised, and our clients that are with us, they moved in early. They moved in where things were calmer, and they allocated. I would definitely advise to allocate a portion of the portfolio into products that might perform well in these environments, such as commodities.
Right.
And in general, I always say, do not change your core investment principles just because there has been a big move or a lot of volatility in the market. You're still doing the same job, and you should have forecast and predicted that volatility is going to happen, shocks are going to happen. So you should prepare for them by allocating a portion of your portfolio and diversifying enough. And then sometimes it's just enough, it's just a matter, are you willing to bear the pain of this volatility? If yes, it means you built your portfolio well, because it's going to happen. If not, probably you were a little bit too exposed or a bit too carried away when things were favorable, and you would have probably either speak to a specialist like us and let them do the job for you, or allocate a portion so that your portfolio is going to be well diversified into an all-weather environment.
Okay. I wanted to ask you a couple of sort of more my level, basic consumer level type questions as well.
Guys.
Well, I mean, it is. I mean, naturally, there are kind of concerns about flight prices.
Yeah.
You've pointed to that a number of times. So if oil spikes, airlines generally pass the cost of the consumer, and that comes in terms of a fuel surcharge.
Yeah.
That's what's outlined. So with summer travel demand starting to peak, the kind of the cheap vacation option era, we're not going to have that in 2026, are we?
No, I would say, according to our expectation, not on the flight part. The flight part, it's going to be a little bit painful for consumers, and yes, especially in Europe. I think this part of the world, funny enough, in terms of supplies, it's well covered. So we don't expect not even a single flight cancellation due to the fuel side. If it's due to general tension, it might happen. But in terms of supply here, we are good. But of course, yes, in terms of input, it's a big input. It's the second largest cost for airlines after labor, the fuel, and it's going to impact in terms of higher fares.
Okay. And the other kind of question I wanted to ask then is when oil prices jump, they hit the pump, the ticket counter pretty much straight away. When they fall, though, we generally don't see the price of goods following suit straight away, right? So are we looking at an inflationary period, regardless of what happens in the Straits?
Yeah. So in our view, yes,
Right.
because it's what we were talking at the start. Even if tension should vanish, and we hope everything is gonna be smooth, there is another round of negotiation, and we are really open for those. If in a favorable scenario, you would have the crude oil probably recovering to healthier levels. We don't think we're gonna go into the 70s straight away, but it's gonna be into the 80s in term of Brent prices. However, the damage that has been done on the refining side and on the fuels, the ones that are used from consumers, from the economic actors, and from industries, that we think is going to take at least 4 to 6 months to go back to more sustainable level. So during this transition, you will have still higher fuel prices, which, yes, is going to, unless we're not going to see demand going down across the economy, this is going to be inflationary. And we have seen in 2022-2023, during the Ukraine crisis, was a big energy crisis, and that brought inflation into global economies.
It did. Okay. A broader kind of macro question, I guess. The UAE and Saudi Arabia have deep sovereign reserves.
Yes.
That much is well known. Does the fact that Gulf producers are well capitalized provide like a floor for the market? Or to what extent does it do that? Because outside looking in, that prevents catastrophic price collapses or explosions, doesn't it, I suppose?
Yes, especially, I would say, especially at home. So we think this is going to be a factor that it will show resilience into local economies, Middle Eastern economies. The GCC is well placed for a higher inflationary period because of what you said, like big reserves and a lot of discipline during the good times means that now we're going to be able, those countries are going to be able to navigate challenges. Another big one is diversification from energy and oil. So now you have, they built other massive industries from real estates to media, finance as well is a big one. So diversifying away from oil and energy will show some caution and resilience over the next month should we have an inflationary period.
Mirco, that's all the time we've got, unfortunately. It's been good to talk to you.
Very good. It was good to have you be on the show.
I appreciate you coming in. Mirco Neri is the co-founder. He's the CEO of Anvik Capital here in Dubai. Thanks again.
Thank you very much.
Appreciate it. This is Mira Business FM.